quality information online about lifetime value. There are a lot of blogs out there, but most of them are either oversimplified or highly complex and intended primarily for data scientists. So with this talk, I will be trying to strike a middle ground. We'll be covering some of the more fundamental elements, but also going into, let's say, moderate and slightly advanced areas. I'll try not to overwhelm anyone. The parts that are complex will be short. So if at any part you feel slightly lost, no worries, we'll quickly be back to something that's less technical. The other reason I wanted to give this talk is that Codeberry Solutions, my studio, has been working to develop a marketing platform to help businesses understand their lifetime value and optimize their marketing budget. And at the end, I'll be asking for some thoughts so that we can design a product that works for our target users, which I think the Malt freelancers are a really good example of. So I will be pausing periodically for questions. So if you ask a question, I probably won't answer it right away, but feel free to just put it down, and then I will circle back periodically and try to address anything that wasn't clear or anything you'd like me to expand. I will also do a questions at the end. Okay. So before starting, a quick bit about my background. I started my career at Capital One, which was probably the leading pioneer in applying data science to businesses. It was founded by some consultants who got tired of something you've probably had experience with, giving advice and finding that your clients don't take it. And so they decided to go into business for themselves and apply their learning. And they founded what's been one of the most successful financial institutions in the US since it was founded. And what was really fun, at least for me there, is it was one of the only cases where the analysts were the business. In almost every other organization, the analytics is a support function that helps the business make smarter decisions. At Capital One, the analysts made the decisions, and the other departments were there to support analytics. After Capital One, I moved to Vistaprint, which attempted to apply highly quantitative and data-driven decision-making into the e-commerce sector. So that was another case where I got to try a whole lot of things, but it was also a learning for me of some of the areas where data-driven decision-making can go wrong. So I got to see what's good and what's bad in both cases. And through Vistaprint, I got to work on the post-merger integration at Albelly, a photo book producer in Netherlands that had outstanding products and a more traditional approach to marketing. And we had the kind of pleasure of trying to figure out how to take the best of both worlds, from a more traditional marketing and a more data-driven approach. Following that, I was the chief revenue officer at Tangelo Games, where I built the business intelligence and the data science team. More recently, I have co-founded Codeberry Solutions. We are a studio that do mobile, web, and business intelligence solutions. All right, on to the presentation. Okay, to start off with, what is lifetime value? Lifetime value is the total profit derived from the entire relationship with a customer. So, a few important points to note about this. We're talking about profit. We're looking at, it's a customer-centric metric, and it is a long-term metric. Oops, sorry. So lifetime value has two pieces to it. There is lifetime and value. That is to say, lifetime is how long does the relationship with the customer last? Some of the metrics that we use to understand this are retention rate, churn, reactivation. The other piece is monetization. That is, how much profit do we derive from the relationship? So some of the metrics that we use for this side are the purchase frequency, average order value, gross margin percentage. Now, LTV is something we can apply both to observed behavior and what we expect in the future. That is to say, we can have historic models and we can have predictive models. In both cases, we will need data to build the models, and we will need to work on our historic models before we can build predictive models. If you don't understand what's happening and why, you will never be able to make any meaningful predictions about the future, and bad predictions are almost always worse than no predictions. So why do we care about LTV? The first is LTV is fundamental to our strategic decision making. It's, in my opinion, the most fundamental piece of understanding whether a business is actually profitable. LTV also can give us a really good lens into understanding customer purchasing patterns. And through that understanding, we can both better serve the customer and increase the business profitability. I'm going to go following this. I'm going to start getting into some more specific applications, but I just want to pause and make sure everything is clear so far. Any questions? Okay. So from a strategic perspective, we could say, let's take this startup. I kind of made up the data, but I think it's pretty representative of the type of what we might see in a startup. We begin with almost no revenue, some expenses, some salary, increasing marketing budget. And now one of the key questions that both the founders and investors are going to want to know is the startup profitable? Well, by conventional measures, it's not. We can look at the net profit and loss, the black bar down here, say, all right, well, it's losing money every month, so it's not profitable. Yes, but that's not a particularly helpful way to analyze businesses, especially businesses that are growing and developing, and any startup should be in that phase, should be growing, because we have the business is acquiring new customers, and if it's able to retain those customers, then they can expect continued revenue from them. And it's, as I think everyone knows, it's much easier to retain a customer than to get a new customer. So we can expect that there's a good chance its revenue is growing really fast, that maybe it's already acquiring customers who will generate a lot of value in the future. And that maybe if we're evaluating the actions that it's taking, the full consequences of those actions, it is already profitable today. So, but how do we evaluate that? Sorry. Okay. So in order to get a better perspective on whether it's profitable, there's two real important questions we need to ask. The first is, are customers generating more profit than they cost to acquire? In terms of metrics, we can say, is the customer acquisition cost, or sorry, is the lifetime value greater than the customer acquisition cost? If it is, then every time we bring in a new customer, we are bringing profit to the business. However, it's not just enough that they be profitable. We also need enough customers. If each customer if LTV is only slightly larger than CAC, we need to have a lot of customers in order to pay the salary, rent, and other fixed costs. If the LTV is much higher than CAC, we don't need quite as many customers to be profitable. So if we know our lifetime value and our CAC, we can measure our marketing ROI. That is our return on investment. If you talk to anyone in finance, they will tell you that return on investment is the fundamental measure of the quality of an investment. And really, marketing is an investment. We are paying money to promote our product in order to acquire customers so that we will get profit from them in the future. We don't always expect them to make our money back right away, especially for products that have long-term, especially for products where customers are going to be purchasing them over and over. Now, I mentioned before when we were talking about historic and predictive models that we need data in order to calculate our LTV and to create an LTV model. So you could be forgiven if you or clients you have say, well, my business is new. I don't have enough historical data to calculate my LTV, so I don't need to worry about this. I would not recommend that approach, though. Just because you cannot calculate your lifetime value does not mean the customers do not have a lifetime value. They will, if you're able to retain customers, they will have a lifetime value. And what we want to be able to do is figure out, all right, I can't measure it, but I can have some kind of realistic expectation of what that lifetime value might be. So I can look at other businesses with similar models, similar products, and try to figure out what is the average order value, how often are customers rebuying, what is their churn or retention rate, and try to get some idea of what a realistic range of lifetime value might be. If you find that we expect a realistic lifetime value for our business model is somewhere between 50 and 100 euros, and your CAC is 90 euros, there's a good chance your business is unprofitable and that you need to fundamentally change something in it. Conversely, if your CAC is 15, then maybe you actually want to be more aggressive and say, hey, our acquisition engine is incredibly efficient. Maybe we could get even more value from this business if we are more aggressive, we increase our marketing budget and try to bring in more customers, even if that means increasing CAC. So moving into applications, we can look at some of our advertising channels, and we could try to figure out where do we want to spend our marketing budget. Now, the simplest view is to look at the CAC column and say, all right, well, email is the most cost-efficient way to bring in customers. Conferences look horrible. Now, sophisticated marketing departments know that customer quality matters as well. And so they might use average order value as a proxy for customer quality and say, you know what, AdWords costs twice as much, but the average order value is double. So that's just as good as email. LinkedIn is a little bit worse because it costs 4 times as much and the customers are only a little bit more valuable than AdWords. So I'm not going to spend much money there, probably cuts that, and conferences is definitely gone. If I have an employee doing conferences, they're probably looking for a new job. But average order value is just part of what makes customers valuable. So we also want to look at the full picture. Now, what's quite common in a lot of businesses is that the highest value customers not only purchase in greater quantities, they purchase more frequently and they purchase for longer. And so you can find that lifetime value is actually really different depending on the type of marketing activity you are doing and the customers it appeals to. Now, naturally, LinkedIn is more of a B2B. Conferences are, you can bring in a different quality of customer because the people who go there are different than people who are actually responding to email advertisements. So if we start looking at the total sales, then we might have a really different picture of how we want to to allocate our marketing budget. We might say, whoa, actually, LinkedIn looks a whole lot better than I expected. The total sales are a lot higher than CAC. AdWords is a little bit better, and email is actually worse than I expected. All right, looks like there's a few questions, so I'm going to pause and address this. So people are saying they can't see the doc. Luis, is there something going on?
What? Sorry?
Oh, okay. People are saying. Okay, all right, looks like people, okay. With some issues with their presentation, but said that it's working fine now. Okay, good question. So that's total sales per their lifetime. So that would be the average order value times the frequency, so every 2 months. So that means every 2 months they would spend $10, and that would be over, and their lifetime is 4 months, so they're making 2 purchases, that's 20. And so the total sales would be kind of the multiplication of those 3. Now, this is not lifetime value because we're not looking at gross margin, but it is a kind of a simple heuristic that advertising departments can use to get some idea of where to, of how to spend their budget most efficiently. Yeah, exactly. So conferences would be 1,200 minus 1,200, but most businesses would have some variable costs, so that's probably still unprofitable. However, if it's a new marketing channel, say, all right, well, the first time we tried it, we got a CAC of 1,200. Maybe we can learn from that, and we can bring the CAC down to 600 or 800, in which case it probably would be a profitable channel. Okay, so let's look at a more retention-centric application. Let's say we have 4 different customers. They all have the same total sales. However, they arrive to that number through different paths. We have one customer who's making quite a lot of very small purchases, a customer who's making one very large purchase and then never buys again. Then we have 2 customers, one of which is making medium-sized purchases over a long period of time, but infrequently, and another customer who is making medium-sized purchases quite intensely, but only for a relatively short period of time. Now, anyone who is doing retention marketing or CRM would probably say, hey, I'm going to take a different approach to these customers. I want to know, for customer B, why did they stop? What can I do? Is the nature of my business something where they only need it once in their lifetime? Or is there some obstacle or some problem with satisfaction that meant they didn't come back? How can I solve their problem so that I can increase the lifetime value of that customer? Likewise, customer D, why did they churn? Why did they buy 4 times in 4 months and stop? Customer A, maybe there's something, some kind of cross-sell or added service that you could offer that would be valuable to them that would increase the average order value. This data is obviously made up, but when you know the real data for the businesses you're working with, we can inform our approach to retention and figure out what are the trends and how do we want to message the customers based on their behavior. There are a lot of ways to get this information, but what we're going to find is that the LTV models can be a really useful tool for getting this information. Okay, so following this, I'm going to get into the methodologies. I'm going to go through a quick explanation of how they work, and then the pros and cons of each methodology, and when they should be applied. Before I get there, I just want to pause and see if there's anything I haven't covered that people were hoping to address. Okay, looks like not. Oh, and I will be going into more detail on some of the applications of LTV when I get to the third methodology, which is predictive modeling. Predictive modeling is the biggest of the three in terms of power, the most difficult to do, but it returns it has some really cool applications, which we'll touch on a bit later. So starting with simple estimation. This is a viable option in some circumstances. Now, if you read most blogs on LTV about that are not intended for data scientists, they're probably going to recommend this approach to you. And they're probably going to recommend one of two ways of measuring LTV. That is to take the average profit per paying customer divided by monthly churn, or the average profit per paying customer times lifetime. That is the number of months in which the customer is active. Now, this approach is helpful for strategic decision making, and it doesn't take that much time to generate. So that's the good side. The downside is that it doesn't fulfill the promise that we're looking for from LTV. It has really limited insights, and a lot of these applications I've been looking at, it is not going to help with. Additionally, it can be really inaccurate in some circumstances. I've seen real-life situations in which simple estimation methodologies had LTV values that were 2 or 3 times the real value, and that could lead to some really bad marketing decisions. They also, but on the other side, it tends to undervalue most startups and their LTV. And the last point is, in most cases, in order to actually calculate numbers correctly, you're probably going to need some SQL or some kind of database access and ability, which is something you will also need for the cohort analysis we would get to next. All right, so when is a simple estimation methodology appropriate? It works well in what we call discrete contractual businesses. That is to say, businesses in which the customer is paying a subscription, and the subscription is the same amount every month. So businesses that have that model are gym memberships, car loans, insurance, Spotify, and Netflix. And all of those, you know what you're going to pay, and they bill you every month. It does not work so well when the amount you're going to pay will vary from payment to payment, and it's especially bad when there's not a subscription. It's not what we call, it's a non-contractual purchase. Now, most business models fall into that last category, what we call continuous non-contractual. So examples of that are Amazon, clothing, airline tickets, food. I mean, almost anything you walk into, you buy gym equipment, anything, whatever it is you're purchasing, there's a good chance you don't know beforehand exactly what you're going to pay, and you are not paying a subscription. Okay, before moving on to cohort analysis, I'll pause for questions. So monthly churn. Yes, that's correct. So you could say monthly churn is, let's say you had in the month of February, you had 1,000 customers. Of those, 800 of them are still customers in March. That would mean you had a churn of 20%, or you would have a overall retention rate of 80%. Okay, continuous. Discrete means that you're always paying the same price every time. So for example, if you go see a movie, probably the movie tickets are more or less the same for every time. When you pay, if you're on the highway or the Autobahn and there's the toll is going to be, the amount is going to be predetermined. And if you're driving to work every day paying a toll, then that toll is going to be the same every day. So yeah, actually, simple estimation work pretty well for SaaS, especially if the amount of your SaaS is predetermined. If we have a SaaS like Amazon Web Services, where which is also SaaS, but any type of SaaS where the amount you're paying can evolve as your business scales, then it's not as, it can still work, but it can be open to inaccuracies. The more that the customers evolve over time, the more problematic the simple estimations are. Okay, so let's move on to cohort analysis. So the first question is, what is a cohort? This is a cohort. A cohort is an ancient Roman military unit that was used in both the Republic and the Empire, and it was equivalent to 1/10 of a legion. However, in the modern era, we use a cohort to refer to a group of people with a shared characteristic. In this case, that shared characteristic is the acquisition period. Now, personally, I like to think of this as vintages of wine. Before the word cohort analysis was popular, I called it vintage analysis. Just made more sense to me. Now, in wine, the year here refers to the year in which the grapes are harvested. So we harvest the grapes, we let them ferment, we put it in the bottle, and that is the 2010 vintage. There's the 2011 vintage, the 2012 vintage, and they will evolve over time. And we look at wine based on the year it was born, so to say. Cohort analysis is the same thing, except when we talk about the year the cohort is born, we're referring to the kind of acquisition year, or in this case, in case of cohort analysis, we're often dealing with shorter time periods, days or months. So there's a good chance you have seen cohort analysis in Google Analytics. This is a really useful graph for understanding how many of the visitors to your website are returning in the following days. We can look and say, all right, this is the cohort. The left column here will be the cohort, or the different rows are each different cohorts. And here we see the day in which new visitors to the site first visited the site. And then here we have the percentage of them which visited the site again in the following days. So this is giving us our visitor retention. Cohort analysis, we can really use it for any type of retention. For LTV, we're going to use it for buyer retention. So here is essentially the same concept, but applied to buyer retention. Here we have monthly cohorts. So what we have here is the percentage of acquired customers who are paying customers. And what we have is in the 0 month, which is their acquisition month, 100% of them are buying customers. That is true by definition. 1 month later, in this case, in this data set, we have 11% are still buying customers. Then 10.7, then 9.9. This is pretty typical of an e-commerce business. New customers, very few of them will repeat soon after, but generally speaking, you have a very big drop-off from after the first month, but then very small drop-offs from after that. That is to say, another way to look at this is to say that the churn is slightly higher, that the number of customers who bought in month 2 is that we had slightly few who bought in month 1, didn't buy again in month 2, or reactivated. Sorry, I'm not explaining that very well. The difference the customers who are appearing in this column here are not necessarily the same as those who are purchasing here. It's just the percentage of the original cohort who are still purchasing. So we could have, let's say we had 1,000 customers in the cohort. Here is 11%, so that's equivalent to 110. And maybe 60 of them purchased again, 50 of them did not. But there were around 47 who reactivated and purchased again. So we can see both so customers becoming dormant and customers becoming reactivated. Now, one important point to note here is that it's a triangle shape because the January cohort doesn't have enough historical data to have a 2-month retention percentage. The older cohorts have more data. That's why we get this triangle shape. So this diagonal here is always the most recent data. I'm going to pause here just to make sure we're clear on any key points here. If this doesn't make sense at the start, I know it can be a little overwhelming if you're not used to these perspectives, but I think once you get used to it being a little weird, it actually starts to become quite easy to interpret. Okay, no questions at the moment. So this is kind of buyer retention. We're looking at the percentage of customers who are retained. We can also look at kind of a euro retention or dollar retention. Now here we are looking at the average profit per acquired customer per month. So if we recall that in month 0, 100% of the customers in the cohorts are paying users, but then it was maybe 10, 11%. So that's why we see a fall of almost 90%. But it's not quite 90% because often the customers who are retained who are retained at higher rates are also purchasing at higher quantities or higher quantities. So what we can see here is the profit that the average customer in the cohort is generating each month following its retention, or following its acquisition, sorry. And if we sum up these values, we're actually getting the LTV to date. That is the sum of the profits from that customer in the cohort, from the average customer in the cohort up to that point. Okay, question. Good question. So Black Friday and Christmas, what you tend to see there is you tend to see a big spike in months 11 and 12. You're likely to see really low rates in all of the in-between months, and then it jumps up again because customers who are seasonal, so this could be, you know, if there's if you're selling products for Oktoberfest or anything that is that has a certain time, you almost always see a spike around months 11 and 12, which is, you know, that equivalent time of year next year. So yeah, I mean, one of the things we can do with as addressing the question about LTV for ad campaigns is that we can apply it. Let me circle back to that in a little bit. That there is a solution for that. But I want to come back to, so the point, if we look at, if we were to sum up the value from the first 12 columns here for a given cohort, that is their 12-month LTV. And to get a better view of that, we can look at a cumulative view of the same numbers. So here we can see that in month 11, which since we're starting at 0, month 11 is 12 months. we have around, between 56 to 58 euros. And so the 12-month LTV is, let's say, 57 euros on average. Now, note the important point is I am selecting a specific period of time. I'm saying 12-month LTV. The reason for that is that I need to make an apples to apples comparison. I cannot say that the November 19 cohort has an LTV of 32 euros and the November 18 cohort has a LTV of 62. That's not fair. That's now, if we look at the first month, we can see, yeah, there's a small decline in the quality from November 18 to November 19, but it's just a few percentage. We choose a specific time frame in order to make sure that we are making an apples to apples comparison. The other reason we choose a specific time frame is because we want to know how long it takes our customers to pay back. If we choose a really like an infinite time period, yeah, we may have a higher LTV than CAC, but if we have to wait forever to get our money back, that's not a good situation. If we say a 12-month LTV, and we want to make sure that the 12-month LTV is greater than CAC, we know that at least that within 12 months, we will have made our money back. So in order to view that, we can add in CAC to this calculation. So this is the same data as the last graph, except I have added a CAC of, that should be 45 euros, not dollars. And so these values are the same values as in the last graph, but subtracting 45. So if you recall, in month 0, it was around 27. So now we have 27 minus 45, which is 18. So this allows us to see when our cohorts are becoming profitable. How much time do they need in order to pay back the money we spent in advertising? This is really important, again, because you need a positive cash flow in order to pay salary, in order to pay your advertising budget. We cannot be waiting forever for our money. And so we can look for this particular set of data. It takes 6-7 months for the for the cohorts to become profitable. Want to pause here for questions? Is there a way to have this data from standard free tools? I haven't found anything. I've been looking at it. That's why we are trying to build a tool that will allow us to do this. So far, the only tools I found that can do this cost a lot of money, many thousands of euros a year, some of them tens of thousands. You can, if you have a data engineer, you could set this all up. You could create a MySQL database and pull this all into Excel. But then you need a really skilled professional to set that all up, which has its own expense. Now, one limitation to this perspective is that if we want to look at the most recent data is all on a diagonal. What we're seeing is that if we want to know what happened 3 months ago, we have to look at this diagonal right here. That's not a really easy way to measure. Even me, who's used to viewing these graphs, is going to have some challenges looking at that. But there is an easy solution. That is, we just change the view a little bit. So this is another way we can look at cohort analysis. We still have the cohorts here, just like we did on the last graph. The difference is that we have changed, instead of months since acquisition, we have changed to the actual month. So this is the retention of the different cohorts in June of 2019. Now, naturally, the June 2019 cohort has a 100% retention rate because that was their acquisition month. The May, for the May cohort, that was their first month since acquisition, second month, and so on. So the triangle is just kind of flipped. Instead of this triangle, we now have this triangle. Now, where this is really helpful is when we want to understand, let's say we did a new retention campaign and we want to understand what type of benefit it had to different KPIs. We can say, all right, well, based on my trends, I expect a drop off of, let's say 0.3, 0.4, somewhere on average. That's usually what we see. It'll be a little different for the more recent cohorts. They tend to drop off faster. And so we can kind of make an expectation for what type of retention we might see. And then we can compare it to actuals. This is also really good when you have some external shock, like a global viral pandemic. And we could look and see what we could kind of compare what type of retention we would have expected versus what we actually see. And that's this view is something I often use when I'm trying to understand external factors. One question, does anyone have clients who have businesses with really, really low or really high retention rates or low churn, and that they might be looking at a situation in which they want to have a very long perspective on LTV, that 12 months just is too short for them? Is that the case for anyone? Okay, looks like no one's answering on that, so I'm gonna take that as no. And to answering Gareth's question, yeah, this is all CRM data. One important point is that there's actually, these are just some of the more core metrics for cohort analysis. When we really want to understand the customer behavior and buying patterns, there's a whole lot of other metrics we can look at, such as the average revenue of paying users, I could go at the gross margin percentage, how the revenue evolves, how gross margin evolves, different things to understand. Another point is that this is overall data, but when we're structuring the query to get this data, we will have the option to kind of segment it by user segment, by acquisition channel. So we could, when we're setting up our cohort models, we could quickly add a filter and say, I want to only look at this value for my email acquisition channel, or I want to look at my segment A, and I want to then do the LTV of segment B, so that we can, that's how we can easily use once we've got it set up, we can easily generate the same values for any cut we want to look at, and allow us to figure out what are the right segments and what are the right acquisition channels to focus on by weighting them by LTV. Okay, so I'm going to skip this slide because it's not relevant for us. Now, for anyone who has some basic understanding of SQL and is pretty good with Excel, you will probably find that cohort analysis is something you could do yourself. This is an example of a SQL query which we could use to get the data. Now, if you don't understand this, no worries. I'm not going to stay on this slide very long. If you do understand it, what you can see is that we have factors like acquisition channel, whatever customer level data we have in our database, we can include here, and then we can filter. We can then kind of filter and sort filter our LTV modeling by those factors: acquisition channel, segment, and so on. Okay, to summarize, the cohort analysis improves upon the simple estimations in every way. What we need for this is we'll need a structured database and some basic SQL or similar skills. We pretty much need that to do this simple estimation, or at least to make sure we're getting it right. If you don't have that, you won't be certain that your calculations in the simple estimation are reliable. Where it differs is then we are plotting the performance of each cohort by month, and then we are selecting a specific time frame to calculate lifetime value. So for example, in the what I was just demonstrating, we were using a 12-month lifetime value. Now, it has quite a few benefits. This is the most accurate way to measure historic LTV. As we were mentioning before, for SaaS with a fixed price, it won't have as many advantages in accuracy, but it still is advantageous in terms of being able to explain why LTV rises and falls. And it's well set up in order to segment by customer and acquisition channel. It has some benefits as well in that we can extrapolate the kind of future. So when once we have 3, 4, 5 months of data on a cohort, we can probably guess that the evolution of that cohort is very similar to the older cohorts. So we can kind of make a good extrapolation of what we're likely to see. And that is really useful for forecasting. I suspect that most of us in the audience don't need to deal with forecasting, but if you do, it's a lot of guesswork, and it's pretty hard to know when you're doing it right or wrong. Cohort analysis can really allow you to take a lot of the human judgment and just rely on a pretty good estimate of what type of revenue you can forecast from your already acquired user base. And if you have investors who want to know what type of revenue they expect from you, or you have to make hiring decisions, that's really useful. Now, its downsides are that it still has limited insights into the LTV we can expect from their new cohorts, especially the cohorts we have just acquired. And it is more time intensive to develop than simple estimation methodologies. It might be, depending on if your data environment is well set up and you're really good with Excel, it might be just a few hours to set up the LTV models. But it could be a few days if you need to play around and figure out what are the right data fields that you should be using, and you don't have a kind of LTV template to follow, and you kind of have to make it up as you go in Excel. All right, pausing for questions. Yeah, so if you have a business intelligence tool that allows you to export data without SQL, that's great. Those tools are expensive though, so not all businesses will be able to afford that. And yeah, so I believe Malt will be sending out the presentation afterward. If not, I would be happy to do that anyway myself. So in case you don't, feel free to reach out to me. I'll put my my email quickly. Okay, so if there's any, and if you have follow-up questions, feel free to reach out. Good question. I actually don't have a good answer. When I tried to find good references for this, I was really struggling. Most of what I learned from my colleagues at Capital One and Vistaprint. So I wish I could provide a better answer. What is this? What are the most basic business? Oh, so basic business. All right, two fundamental tools I like. One is Sife. It just allows you to that's kind of a marketing dashboard. Another one would be Google Data Studio. It's harder to use. So Sife is just kind of a time saver in that it allows you to integrate all of your Facebook, Instagram, LinkedIn, AdWords, all of those into one source. And it has a fairly low subscription, and it's very easy to set up. Google's Data Studio is a lot more powerful, and it's it's just spelled right above. The Google's Data Studio is more powerful, and it has a lot more flexibility in what you can include, and it's free, but it's annoying to learn. So Juliet is my co-founder at Cohort Solutions. So Power BI is probably the most powerful, versatile, and most affordable business intelligence tool. Tableau is more expensive. It's stronger for visualization. Has a lot less well-rounded features though. The challenge is that those are really business analyst tools. So if you're not interested in taking a course to how to learn them, then it's not really the best. Yeah, so what Jocelyn says, you're right. Data Studio is not it's for visualizing. As for pulling data, extracting data, I mean, there's a lot of options. It really depends on your needs, whether you have, if you have your data, there's some, like for example, if you have a mobile app and you're using Firebase or some of those other backend platforms, you may have a pretty good kind of built-in like BigQuery. But you need some technical skills to do that. Most of the affordable BI solutions are going to either cost money, often a lot of money, or require some data engineering, or at least data mining skills in order to make use of. It's a pretty complex question, and that would be probably its own talk or own series of talks. So I'm going to move on to predictive modeling. Yeah, so I see we have some people who know a little bit, who are kind of knowledgeable in this world. All right. So with predictive modeling, we are moving up in both the value and difficulty. We could here we have, we have higher difficulty, higher value. Predictive models help us understand what will happen, and we can even have prescriptive models that can cover how to make it happen. Now, if we say that the simple estimation is kind of down here on the graph, cohort analysis at the high end of descriptive analytics and moving a little bit into diagnostic, predictive analytics is based here. Now, we're going to want to start at the higher level. We need to have our descriptive analysis and then our diagnostic analysis built before we can move into predictive. And then we need to do that before we can move into prescriptive. So I will cover now some more applications of predictive modeling. So one of the benefits is that they let you test new ideas quickly and easily. Let's say, for example, that you or someone on your team has an idea to attract high-value customers. Maybe it's a different pricing, maybe it's a different promotion, or featuring a different product in your advertising. Now, that will almost certainly lead to an increase in CAC. Whenever you target higher value customers, your CAC is almost always going to decrease. But you also expect an increase in LTV. The question is the increase in LTV enough to compensate the higher CAC? Now, if we only have cohort analysis, or even worse, the simple estimations to measure that, you're going to need to wait months and months to have enough data in order to measure measure the results of the test. If we have a predictive model, we can run the test, and within minutes, hours, or days, depending on the model, you can have results and you can take action. If the test turns out to be a success, you don't have to choose between guessing it worked and hoping you're not making a bad decision by operating blindly. You can have a very high certainty that whether your test worked and then take advantage. Similarly, in the current environment, a lot of businesses are cutting back or even eliminating their marketing budget altogether. That presents opportunities. We're seeing advertising rates fall a lot. If you or your clients have a business that is actually doing okay in the current environment, that could be a really interesting opportunity to try out advertising channels that were previously too expensive. Now, you won't know what quality of customer you're going to get in these. Maybe the type of the type of audience you're appealing to is completely different, and so the quality could be completely different. Now, again, if you only have a cohort analysis to go on, you're going to have to wait some time to get an understanding, to have a real read on the quality of the customers. However, if you have a predictive LTV model, you can have you can get a much stronger idea much faster and figure out, is this a channel we should continue with, or was that an idea worth testing, but it didn't work out? We can also have models that try to identify events before they happen, such as identifying which customers are likely to be high-value customers before they have purchased. And one thing about high-value customers, especially if you are selling a B2B product, is they often have to get authorization from their boss, and they usually have more complex needs. And so they probably need more information before they can make their decision. Imagine if you could have a customer agent, or even you yourself, if you're like, reach out to them and help them with their buying decision. If they have questions and they can't find the information on their website, maybe it's not on the website, you can address their needs so that you can greatly increase your ability to convert high value customers. But because that's very time intensive, it's not something you would want to do for all customers. So it's only an effective strategy if you can figure out who is worth taking the time to talk to before they buy. Similarly, once you have high value customers, how great would it be if you could identify the type of behaviors that indicate they are likely to stop becoming a customer, either because they don't need, because if they're going to change to a competitor. What if you could identify you could identify who they are, talk to them, and figure out what it is that would make them leave? Now, maybe you won't be able to change their mind, but it's still really valuable to have that information before they leave and they probably unsubscribe from your email, and you lose the chance to understand what made them make that decision. Now, we can also develop predictive models to figure out what type of customer segment people are likely to be in, and even predict their customer segment before they have bought. Now, imagine you have a customer segment that only buys at a discount. And so in most businesses find that discounts can be effective because, yeah, they lose money on the customers who would have paid full price, but they gain a lot of money from just getting more customers. So even if LTV goes down because the gross margin percent and revenue decrease, the amount of increased acquisition more than makes up for it. But wouldn't it be better if you could only offer the discount to the people who would not buy otherwise, and still charge full price to the customers who were willing to pay full price? That would allow you to possibly offer steeper discounts, like a bigger discount to the customers who need it, and convert even more of them, while greatly increasing the lifetime value of the customer segment who does not need the discount. So I'm going to pause for a second. Okay, so we were just talking about SIFE before. But now, these are some of at least my favorite applications for predictive modeling. There are a lot of other ones. This is something you can use your creativity for, and the applications will depend on each business model. Before moving on to a little bit of the how predictive models, I want to pause for questions. Okay, so no questions so far, so we'll move on. Now, when you read on blogs about predictive modeling, the ones that are, as mentioned before, most of them are either really oversimplified or they're for data scientists. And the blogs that are for data scientists tend to focus on this element, which is the actual building the model. And this is the data engineering part. And here we have the statistical modeling part. Now, that to me is a problem because before we can get there, there's a few steps we absolutely need to consider. The first is we have to conduct extensive diagnostic analysis. I've seen so many times of brilliant statisticians who make models which include variables which, to anyone who understands the business, it's obvious don't have any predictive value. There's some noise in the data that leads you to think there's some predictive variable that just will not continue to provide predictive power in the future. Similarly, if you don't understand the business problem, it's really likely that there will be miscommunication between the data scientist who's building the model and the person who actually plans to use the model. Now, what's really common is data scientists build a really awesome, interesting model that helps you predict something which is you have no power to change. Now, if they can tell you, if you could predict the stock market, you can make a lot of money. But if I predict something that you don't care about and you have and doesn't matter, the prediction is academically interesting but meaningless. So there needs to be have a clear alignment on what the business problem is, what the business problem we're trying to solve is, and that's a lot easier when the data scientist has already got a really good grasp of the business. And then we can select the right statistical model for the specific type of prediction we're going to try to make. I'm not going to go into any statistics here, but suffice to say, there are many types of approaches that have different pros and cons. We need to take into account those metrics, the kind of dimensions of continuous, discrete, contractual, non-contractual. That's really important here. But other variables, other variables will matter as well. Now, keep in mind, humans can often interpret what someone is trying to say, even when they have said it incorrectly, but artificial intelligence cannot. In this case, we have someone who's very ironically misspelled knowledge. Now, most of you probably could understand what they're trying to say, and Google could as well, because Google has been programmed with the ability to recognize misspellings and common alternative phrasings. But most artificial intelligence does not have that, will not have that ability, because it only has that if the programmers have given it that ability. So the artificial intelligence will do exactly what you tell it to do. So it's very important that precision and being careful with what you're asking. It's really common to see that the artificial intelligence, it tends to find the kind of laziest, best way to answer your question, even if that's not at all what you're asking, what you meant to ask, because there was some minor room for interpretation and it found some other alternative interpretation you did not mean. So to summarize predictive modeling, we're going to need sufficient data, time, and understanding. Now, predictive models will generally be solving a single business problem, and they're going to need relevant historical data. So let's say we have an established business, but we want to have a predictive model for a new product. There's a risk that the historical data isn't relevant to that new product because the buying behavior is different, or the type of customers who are purchasing their behavior are different, or just there's a lot of variables that can lead to the historical data not being a good indication of what's likely to happen in the future. I think I've covered the need for the data scientists have expertise in statistics and a deep understanding of the business. It's worth mentioning that there are quite a few data scientists who would disagree with that statement. They have what I consider kind of more arrogant approach that you really only need statistics and that you can come into any problem and solve it. There was a time in my life when I actually believed that, and but learned from experience that when you that it's understanding your material is essential, because you do not know what you do not know. So the strengths of LTV modeling. It's the only model that can generate an LTV prediction for individual customers. If we want to configure the cohort analysis to measure historical LTV for individual customers, we can do that. But it's not powerful at all in terms of predicting what those individual customers are likely to do. That versus it's intended to work on cohorts. By comparison, the predictive LTV modeling is intended to work at the individual customer level. So when we want to know what an individual will do, we want a predictive model. Now, most importantly, with that prediction, we can identify actionable opportunities to increase revenue and also to better serve the customer. This is we showed that it's really useful for being able to test new ideas by getting feedback on those ideas immediately. And it is the best model for predicting future revenue. The cohort analysis has strengths in there, but it's when I'm doing predictions, when I'm forecasting, I like to use both lenses and try to incorporate both perspectives. So it does have some notable cons. It's resource intensive to build, and you have to maintain it. It isn't just something that you build and it's ready. So if you are bringing in data scientists to work on it, you're going to want to have a continuing relationship with them, because all models, we're continually refining them and making sure to incorporate, to adjust them as the world evolves around us, also as your business evolves. Now, most businesses are going to want multiple predictive models. That's because they really only address a single question, and most businesses are going to want to have multiple questions they want answered. Small mistakes can have disproportionate consequences. And always remember, bad predictions are worse than no predictions. Your best guess is often better than a bad prediction. And of course, changes to your pricing, your product and services can undermine the model. Okay, so I'm going to take about 5 more minutes, and then we can close the talk. Quick questions on predictive modeling. Okay, so if I could emphasize only 4 points from this talk, it would be that LTV is both a concept and a metric. To establish sustainable profitability, my recommendation is to focus on making sure your lifetime value is greater than your CAC, and that you're maximizing the number of customers you're acquiring. Sounds pretty obvious, but if you really focus on those 2 approaches, you are really likely to have success. And in my opinion, most businesses should do a cohort analysis. Predictive models are crazy powerful, but only if done correctly, which is demanding. So you need to consider if it's appropriate in each situation. Now, lastly, there is, I mentioned before that our Codeberry Solutions, we are building a marketing analytics tool to help optimize your budget. So our goal is to be able to help businesses make these calculations without needing to get one of the really expensive business intelligence tools. Whereas, so Juliet mentioned DataBox and Mixpanel, which are both great, but they're not going to, but all of the kind of easier to use options that are not extremely expensive will not be able to help you with your lifetime value. So I would like to send you a very quick questionnaire so that so that you can help us make design a product that will really work for you. And that is all. So, all right, one question. what is an example of a business where predictive analysis is relevant? Yes, Vistaprint would certainly use predictive analysis. We struggle a lot to build a good model that actually outperforms our default expectation. But yeah, it's predictive analysis is essentially, I would say, once you have a more stable product set and a probably I don't know exactly, but maybe €1 million in revenue or more, then you could it's something you can consider. It's a lot easier when you have tens of millions though, just to be able to afford the resources and make sure that you are building a really high quality model. Okay, well, seems that's, yes. All right, seems that's it. So right before Veronique's question, I sent the link to the questionnaire, but it will also be in the presentation. So anyone who checks out our presentation will be able to find it. And again, I appreciate your time. I hope this has been valuable. I would greatly appreciate if you could help us design a better product for all of you. Let me try it again. Oh, okay, sorry.
Oh, I know. It's because it's just for me. You have to select our assistants too.
Yes, all right, yeah, so
right
I was
now.
only saying it to Luis, my bad. That's why no one could see when I was writing Scythe. Now I understand. Yeah, still new to Zoom here, my apologies. So yes, and lastly, if you have, yeah, that's it, only her answer. And again, if you have follow-up questions, feel free to reach out, and Juliet or I will do our best to provide you a better answer than I was able to give during the talk.
Well, thanks a lot, Phil, and thanks all to be here and to join. And I hope we will see each other soon. And well, have a good lunch, everybody.
All right. Bye, everyone. Thanks for your time.
Thank you. Bye.